Hello. Very excited to talk about banking and DeFi with some banks and DeFi professionals. Let's start with a quick intro. David, did you want to kick us off?
Sure. I'm Dave Cunningham. I lead strategy and partnerships for digital assets at Citi. It's an American startup bank scaling internationally. We're trying to do our best, but yeah, it's going pretty well.
Paul?
Hi, I'm Paul Neuner. I'm the founder and CEO of Telcoin. So we are a conditionally approved digital asset depository institution in the state of Nebraska, but also able to take nationwide clients. We are planning to launch in December. It's been a long road. We started in 2017, so we're on year 8 already, and we're finally opening things up. But we're also the first bank charter that is explicitly authorized to connect U.S. consumers with DeFi. So very happy to be on this panel and appreciate the invitation.
Jeff?
Hi, I'm Jeff Kendrick. I run digital asset research for Standard Chartered Bank. People pretty much know my research for one of either two things. So I write research on public coins and tokens. For example, in April 2023, Bitcoin was 25K. I predicted to move to 100K by the end of last year, which thankfully worked out quite nicely. Or on stable coins, where Scott Bessent uses my $2 trillion number in Congress today. As far as I'm aware, I remain the only person in any bank globally doing this job full time. So I just have to say, monopolies are good when you're in the center of one.
Hey, I'm Eric, co-founder and CEO of Injective Labs, and I'm currently CEO of Injective Foundation. So Injective is a highly performing blockchain built for financial applications. It's been one of the top blockchains in the space, specifically tailored towards advanced trading, advanced financial instruments.
Thank you. So this panel is called Banking Meets DeFi. I want to start with the banks. David, maybe you can kick us off first. How are you all thinking about DeFi? How has it changed in recent years? What kind of use cases? Tell us about your team.
So essentially for us, I mean, Citi's been building and experimenting with blockchain since about 2014 or so. I joined in 3 years ago, and essentially, we didn't do a lot for a long time that made it live. In fact, I joined to lead our strategy and figure out, what could we do to use this technology to help what we do today, which is move about $5 trillion a day in my division. So where can this help? And there's kind of that dilemma, are you trying to disrupt yourself or what are you trying to do? Essentially, the consensus reached was we're not trying to disrupt ourselves. We're just trying to improve things and take advantage of what we have today and augment it with other capabilities. So thankfully, we set about building something and we got Citi Token Services live as a solution. Which was during the harder days of the previous U.S. administration when, you had to get things like a non-objection 1179 to do anything or even to change slightly what you've already been talking about for years. So, we have something which we built which moves the dollar 24/7 cross-border for our clients. And is going pretty well. But I think everything has changed for us now with the new administration. Public blockchain is now open to GSIBs, and we're actively progressing down that road. You probably have seen some announcements about Citi involved in various consortia related to stablecoins that was in the media over the weekend and last week. For us, we're always just trying to figure out, and we've spent a lot of money. My former colleague who was there recently, Tony McLaughlin, he started a thing, the Regulated Liability Network, which was saying that, we have to figure out as incumbents, central banks, commercial banks, and others, how digital assets become interoperable. And it hasn't happened at scale yet, even though we've had Bank of International Settlements and other projects since then. Meanwhile, stablecoins have come along, and and kind of got some momentum, which, to complement Jeff's thing, I don't know how this arrived here, but this is my recent stablecoin report. I really don't know who put this here, but anyway, we predicted going to maybe, we said 3.7 trillion, and Scott Bessent took that figure as well and quoted it, but we updated it a few weeks ago to say maybe 4 trillion by 2030. But anyway, this isn't about who can say the biggest number. What we do predict happens though is that we have stablecoins are certainly a thing. We have tokenized bank deposits and other bank tokens we predict will grow. I mean, we're moving billions on a daily basis ourselves. JP Morgan, they're another American bank, if you haven't heard of them. They're also doing it. There's lots happening in the space. So I think now with the new administration, we certainly have the large institutions are here to not to play, but to actually to do stuff. So it's kind of exciting.
We'll definitely get into the regulatory conversation in a little bit. Jeff, what about you? Is Standard Chartered thinking about DeFi in a similar way?
We've also been in this space for quite a long time now, excuse me, and have been doing quite a lot of things. So both in the mothership, if you like, and also via our SC Ventures arm, where we've spun out a number of companies that you've probably heard of. So the largest and most successful of those is Zodia Markets and Zodia Custody. They make markets in pretty much everything now in spot out of the UK. They have custody businesses, so headed out of the UK, but also out of Ireland. We have also within SC Ventures spun out Libera, so that's our sort of tokenization link, if you like. And now in the mothership, we also make spot BTC ETH out of London, out of Dubai. We have custody globally. We have plans to roll out the spot business globally as well. So we're the only GSIB now making markets in spot BTC ETH. There's a lot of regulatory clarity and other things that could assist us down the track, but it's fair to say we see this as transformational. And so we're trying to get ahead of each bucket as we can. Obviously, in crypto markets, in stable coins, tokenized real-world assets as well, when we get some more clarity, pardon the pun, out of the US, hopefully soon as well. So lots of different fingers in lots of pies, and mostly trying to get ahead of what we see is very, very likely in the quite near term to start transforming asset markets like FX, where you can easily see 20 or 30% on-chain in the next couple of years, for example. So trying to have quite a few of those where we're in line to have a Hong Kong dollar stablecoin as well. So thinking about that avenue too. So lots of different areas just now.
Paul, what do you see as some of the biggest real-world use cases for banks?
Well, I think that, first of all, if you look back at, and this, David was talking about the transition from first just looking at this as a disruption versus, I think now it's looked at as the technology of money, the technology of banking. And so I think from a use case perspective, when most of people end up using stablecoins, they're not going to realize it's a stablecoin. It's digital cash. It's something that is really transparent. And another technology that under the hood you're maybe not aware of what's actually happening. In our case, like our journey started with helping draft the second crypto banking law in the United States. The first one was in the state of Wyoming, and I think that charter was really focused on how do you disrupt? How do we disrupt banking? Whereas we really made a concerted effort to cooperate with the Nebraska bankers and just in general look at it more of how does a bank get into this? How do you see this as something that can actually go mainstream? And so that's kind of our focus, and not really about viewing crypto as some value-added service that that banks can get into, but actually as the future of the technology of banking.
Eric, from an infrastructure perspective, what's the current ecosystem looking like? I mean, what are the pain points to meet some of these use cases? Are we there yet?
So certainly the base layer infrastructure is largely there. However, it's yet to be battle tested, especially at the scale of adoption and also the scale of usage for a lot of the bank use cases to have the full-on global coverage. We're talking about basically, Injective being able to achieve like 10 or 20,000 TPS or trades per second, and most of the high throughput blockchain roughly around the same range. Some layer 2 solutions perhaps could surpass it, but we've all seen a lot of like stability related issues. So on the base layer, basically, for 99% of the traffic or like trading activity or any type of transaction activity or any type of financial activity, it can certainly handle it, but it might not be able to absorb, the absolute peak and trough or like high traffic time or, sudden spike in traffic that, most people are expecting on like a global scale. On the other hand, I think the general financial mechanism and also all the financial engineering that comes into DeFi and all the experimentation that goes into DeFi has already taken in such a mature shape at this point where largely you can find an equivalent type of like DeFi primitive or some sort of like financial product that mirrors or behaves in a very similar way to any type of like traditional counterparts. Obviously, there's some exceptions to that currently with on-chain options still being extremely limited due to the lack of margining systems that can go beyond multiple like exchange venues or DEX venues. So I think we're almost there. Obviously, the technology or underlying infrastructure is evolving at a much higher speed than the technological adoption curve for the larger institutions. So by the time the activity or the volume catches up to fully migrating over on chain or fully kind of like being supported on chain, the technology will be there to support it.
David, yeah.
Just on, I mean, it's a debate that often comes up, and it's often like I lead our partnerships globally as well for digital assets, and often when people are trying to sell solutions to the likes of Citi, they like to quote, the transactions per second and 5,000, 6,000, 20,000. We're working on 100,000 this year. All of this type of stuff. To be honest, more than 5,000 transactions per second is not really necessary except in real edge cases. So I think, just as an example, that I don't think the technology is the problem here. I think you'll agree from Telcoin perspective, you could provide technology, and many of the providers here can provide the technology that would absolutely accommodate the scale for global financial market infrastructures. The thing that's kind of limiting is just the regulatory moves and really just collaboration around agreeing on who governs what. So we've had we had a few different things that have successfully emerged as rules of the road for financial services. SWIFT is one. Often many people kind of point at SWIFT and say, "Oh, it's just a messaging layer," but it's something that everybody signs up to. And yes, the money moves on a different manner. And blockchain could bring the data, the messaging, the cash and the assets all together. Absolutely valid. But at least they have a cooperative and rules of the road for how to move money. Euroclear is another one. When Visa was formed in 1960, that was another one where people came together to do it. So really what I really feel is that it's not the technology that's the limiting factor. It's just the financial market infrastructures agreeing how to do things, how to agree for interoperability, how to agree for certain other elements. That's the constraining factor for more traditional finance moving on chain. That would be my 2 cents anyway.
Yeah, I agree. I mean, if you remember the dawn of the internet, everyone thought within 2 years we'd be on IPv6, if anyone remembers that. We're still on IPv4. So I agree that it's not necessarily about the technology, but regulatory clarity that just sets the rules of the road.
Jeff, do you agree?
Yeah, I think that's right. I think if we could get regulatory clarity in the US, obviously we need the US government to reopen. That'll be a great start. Then Clarity Act passed, then SEC guidelines, let's say in the next 3 or 4 months, that would be fantastic. And then if we could also get clarity between regulations in different centers, that would also be super helpful, right? So if we end up with different rules in the US than we have under MiCA, that'll be problematic, etc. So we need some interoperability between regulators will be also fantastic. And then we also probably need TradFi just to accept the chain it's going to use, the rails it's going to use, etc. So let's just assume that's Ethereum for a lot of TradFi stuff, even though we could debate the tech against some others, right? But let's just say it's Ethereum, and then you have an agreement that that's where a lot of where this is going. You'll then get tokenized assets, etc., kind of start to build on top of that. But we're still in the early stages of each of those steps, so it becomes quite tricky for organizations like banks that, quite frankly, are still somewhat conservative in the whole, right? So getting some agreement, regulators agree on where this is going, I think will be fantastic.
Yeah, the 3 weeks into the government shutdown's going very strong. I'm not hearing very positive reports from Washington. I guess, David, you mentioned there's been a lot of regulatory progress recently, but there are still some pain points, as Geoff mentioned. What do you see as the most pressing matter when it comes to policy?
I think there's, I don't have a favorite pain point in that space. I think maybe just to give something, because I think Geoff and others can speak more eloquently about particular legislation. But I think the change we've seen since the January 23rd executive order, which signaled stablecoins are something that the US really wants to push, which inherently live on public chain, and then CBDCs are something that the executive order said was a threat to American sovereignty, which I'm gathering is largely negative towards it, though English isn't my first language. That public chain is something that's now open, and then we've had Genius and other stuff come to life. I think what's really the most complicated thing, really, in big banks adopting this, and Geoff, I know the Standard Chartered Zodia Markets and Zodia Custody. It's been a brilliant strategy, I think, by Standard Chartered to do that stuff in a separate kind of sister-funded entity to do this, because doing it in a very large entity is hard. But which is why I look like I do when I'm really only 25. But essentially, now we're all getting to do this in the large organizations, but you still have your own internal and compliance in that. And like to scale into multiple countries, you still have to get the legal clarity and the regulatory clarity in all different countries. So let's say today we're live in New York, Singapore, Hong Kong, and London with City Token Services, and Dublin will come in a few weeks' time. But like each other of the other 90 or so regulated places where we're regulated, it each requires individual compliance. It's not like we just turn it on across the globe. So what really needs to update more is internal processes for managing risk at scale in this area on a global level. And I think with more regulatory clarity, it's, as you'll hear in every conference, more regulatory clarity is coming, so it's easier to turn on different locations, but it's still a lot of work. And the biggest barrier is, let's say, your own internal committees and compliance, and convincing people that no, you're actually allowed to do this, and getting people to turn up to those meetings and approve stuff. Yeah, that's the hard stuff.
Yeah, I agree with that. It remains very, very difficult, right? Like the regulatory response to 2008 was to take anything non-standard and put it into, basically force all of that out into non-bank banks, right? And now that what was in non-bank banks is now becoming so systemically important, i.e. stablecoins and other payment rails type stuff that we're talking about, it needs to now circle back into the majors who are, around, trustworthy, etc., regulated, like regulators have oversight of what we do, what Citi does. So the bigger powers, like BIS, for example, still need to kind of step up and allow banks like ours to do what's required, which is to make this new payments rail system more trustworthy. Yeah, so I think we will get there. It's taking time. It's taking education internally in organisations like ours as well, right? So there's a lot of anchoring bias that remains. In 2022, we had very bad headlines in this asset class, right? So we need to still work on that education piece as well, I think, even internally. But again, I think we're getting there, and we're getting there quite quickly under this US administration.
Paul, you have a lot of experience in the U.S., both on the federal level and with state regulators. How are you thinking about the current environment?
Well, it's obviously improved a lot. I mean, a great thing in the United States, we have this state system. There's the interstate banking law that's been around for a very long time that said that a Hawaii bank or a Nebraska bank can operate with all of the powers of an OCC federally chartered bank. And so I think a great thing that, at least from our perspective, happened with Genius is that it extended that interstate banking system to stablecoins. I think the next step is really seeing how this plays out in terms of rules. Treasury put out a request for comment recently, and that's really where it's key. Like, how do you actually plug this into the legacy system? The fact that you have these stable coins out there all backed by treasuries, I'm not sure that really makes a whole lot of sense. If a bank can actually do this, can they use a sub account of their master account? It would work a lot better, right? So there's all sorts of I think also in the BSA, Bank Secrecy Act, or anti-money laundering type regulation, there needs to be some upgrades there too. So I think the next step is figuring out how does this really plug in and become properly operational or mainstream.
I want to shift gears a little bit. Tokenization is such a big trend right now. Tokenized stocks, tokenized deposits. Eric, I want to start with you. Do you see tokenization as an inevitable next step for capital markets? Are we seeing a bit of a bubble? Is it a passing trend? What are you noticing?
Yeah, so if you asked me like 2 years ago or like a year ago, I would certainly say that tokenization of a lot of these assets are certainly not going to be as useful or going to be as well adopted as like the headlines are putting it out to be. Basically, just because you tokenize like a certain treasury node in like a permission setting, or just because you tokenize like a certain like REIT fund or whatever on like on-chain setting, suddenly it's gonna just have like a completely new like a life, or basically get a complete new influx of buyers or volume, et cetera. But what truly surprised me was basically the success of Helix with the I asset, which is basically like a virtualized, tokenization of a lot of like the equities, private or public, and the volume coming from those have just been absolutely humbling. I think reaching up to like 8 to 10 billion at this point. So I think in a general sense, there is a massive user base within the on-chain community, within the DeFi community. They're looking to gain exposure to a lot of these assets. Obviously, due to the current like regulatory like uncertainty and the lack of clarity on how to go about structuring these type of DeFi products, it's been highly challenging to make it into like a full-on like one-to-one representation of these like type of like on-chain asset, while allowing for like a more like public or less permission engagement. But I do see like a significant promise here if there was a breadth or like a critical mass of asset being achieved, instead of like one-off like tokenization of like one particular fund. They're extremely long horizon, which we basically view it as kind of like an alternative rail or like alternative like settlement pipeline for like a traditional kind of like fundraising environment.
David, I see you nodding. Do you agree?
Oh yeah. Well, I think what I suppose I live in the mainly in the tokenized kind of cash business and that. So obviously I look at everything with a bias towards that. But I have seen, in our security services division and investor services division, the tokenization of funds and securities and that, it's all coming. But the interesting thing, kind of like you've probably all seen a lot of tokenized trade finance solutions down through the years, and it was always systemizing paper-based processes like letters of credit or bills of exchange or something. But the problem with it was that the cash leg was not 24/7 as well. So now what we're doing with the investor and security services businesses, as they tokenize more, we can bring a cash leg that's 24/7 as well. And then you get this delivery versus payment or atomic settlement, which is really interesting, that reduces risk, and that is truly meaningful. So I think the two things coming together are what you need for real volumes to happen. So I think we're going to see a massive explosion in that. And that tokenized cash rail could be stablecoin if it's at a decent enough. If you can get enough of them and there's enough liquidity there, or it could be tokenized cash and tokenized deposits like what we have. And yeah, so I think the two things will grow together, but the appetite for and the efficiencies that we're seeing from doing this, the appetite is there, the regulatory clarity is there, the technology is there. It's just about getting on and doing it now. But I think that link of cash plus asset coming together for delivery versus payment, that's what I'm very excited about.
Paul, yeah.
Yeah, I agree. I think that it's very hard. So many people have come up with amazing ideas for all the applications of all this, and it's going to be exciting to see them come to fruition, but it's very hard to deploy a lot of it without that bottom layer of the technology of money or tokenized cash. I don't really even like the word stablecoin. I feel like that's a throwback to the unbanked crypto era, where you had one asset that was engineered to represent or peg its value to an underlying asset. Whereas if a stablecoin is issued by a bank, to me that's digital cash, because legally that asset, it is a legal representation of the underlying asset. You can trust. That's the reason why banks are a liability of a bank is exempt from securities law, right? So that's key, that you have that kind of certainty at the bottom layer. There's so many exciting things you can build on top.
I agree. I think it's going to be massive, actually, and I'll probably go even slightly further than the other guys. I think we have now the tokenized cash version, call it what you like. We have the tokenized money market fund stuff. We have each of these weekend liquid now. We have a large push now already into tokenized equities. We will get Clarity Act, SEC guidelines. We'll work out what we can do in DeFi, what's legitimate, what can scale in DeFi. And I think this is all like in the next 6 to 9 months, actually. And so I think if we today have something like $30 billion in tokenized real-world assets outstanding, in 12 months we're going to be at like 300 billion. So I think you're just at that acceleration point where regulation, liquidity, and others can come together, and we can move very, very quickly. So it's equities now. It will be tokenized broader funds at some stage. Like when I talk to the real money accounts at some stage next year, one of the main ones that possibly starts with B is going to say, okay, here's like $50 billion fund, which is now all in tokenized space. And when after that, you'll get all the FOMO from all the others doing exactly the same, right? So we're just now at that tipping point in tokenized real-world asset space. And the average person will end up with a new wallet in their phone. They won't know the cash part is stablecoins. They won't know the equity part is tokenized Apple stock. They won't know the money market fund is with BUIDL, right? So, and because of AI agents next year, when everyone has that as well, every time you get paid every month, an individual will be able to be super capital efficient, right? So money comes in and goes out immediately to each of these assets, and you can get in and out of them on weekends. You can do stuff in DeFi with them to get extra leverage as well. So I think we're just there now at this explosion. So actually, for me, if 2025 has been about stablecoins, 2026 might be all about this quite seriously.
Eric, I see you nodding. Do you agree?
Yeah, I think I have like a kind of like a relatively like a pessimistic view about kind of like currently what the stablecoin industry is like shaping up, or like where a lot of these product innovations are gearing towards. And what I hope for a space to have is exactly what you guys talk about, which is basically like a digital cash, or like a tokenized cash, instead of like a credit representation of like an actively managed treasury strategy, or even like hedge fund strategy, et cetera, which has been highly successful. But at the same time, we don't need 20 or like 50 of these. And I think this is truly where the space should be going, and this is what's like a big missing piece in the industry at the moment.
I guess looking ahead, do you see stablecoins as more of a back-end financial infrastructure tool, or will it be like consumer payments method, or payments?
I think that really goes into
Both, I guess.
a whole host of like regulation when it comes to like payment laws, etc. Especially when it comes to peer-to-peer payments. That I know like PayPal is structured in the way that it is, Venmo is structured in the way that it is. Same reason why like Cash App is getting a lot of smack for the way that it is. So it's very hard for me to imagine or like envision a world where there's hyper like critical mass adoption of stablecoin at the current shape and form that's used for like peer-to-peer payment or any type of like other usages in the form that like billions of people like use it at the current day without any type of like update in terms of regulation or without any type of like clarity in terms of like how the payment space will evolve.
I think it depends where you are. So obviously our bank is footprint markets in EM in Asia, Africa, Middle East, right? And I mean, this is happening already. So so for me, it depends on how strong the demand is. In EM, the demand is strong because the broader need is there. Like, you have 1.7 billion remain unbanked today. So they're starting to use payment rails via stablecoins. The demand to have savings accounts in dollar-based bank accounts, which is effectively what stables are as well, is massive in EM. So it's sort of starting in EM. It then will circle back, I think, in developed markets. I have a lot of conversations with corporate treasurers now, Midwest, US corporates, that are saying, hey, Jeff, we've heard of stables. What are they? How do we use them? How can this make us more capital efficient? And so it'll sort of circle back. Like in the same way in this country, when you first used WhatsApp yourself in your phone, you used it to text your friends in other countries because it was free. And now you only ever use WhatsApp, right? So I think you see something similar happen with payments rails on the back of stables.
Yeah, I think Jeff makes a great point. I think the largest outbound remittance corridor from Europe is Germany to Turkey. But if you go into the World Bank's website right now, it's completely gone. Like everybody, 90% of that corridor has moved over informally to stablecoins. So, but I don't think that, at least in developed markets, do consumers really want to hold 15 different branded stablecoins? Probably not. There's definitely a use case. It's a lot better than say a gift card for Amazon, so it's a great way for, I think, companies to keep money within their balance sheet or in their ecosystem. But yeah, I feel that consumers are going to want more. They want to use digital dollars or digital RMB or whatever.
Yeah, I think maybe to just a few things that I just have to get off my chest, and I'm going to do it to you because my counselor doesn't want to hear about this stuff. So Jeff's statistics are brilliant. I use them myself when I'm looking for more funding. Probably everybody else here uses them in their decks. Yeah, and thank you. I even use some of our own that my colleague Ronit Ghosh and the team do, but it's always better to have a third-party one, and yours are brilliant. So I use them for that. What I do find is that we lump together the retail use of stablecoins and the commercial and the potential for institutions and commercial organizations to use stablecoins. That hasn't happened to the degree we might expect as yet, because the incentives are slightly different for different folks to use these things. So if you're in a high inflation economy, Turkey, Egypt, Nigeria, you want to get out of your local currency into a more stable thing. And if you can get access to dollars, you'll do it. If you can get digital dollars, that's easier. Great. If they start paying you yield on top of that, that's an extra bonus as well. And then you get used to using that. If you're a large global multinational who has a daily overdraft limit with us of $2 billion and has people around the world who are managing their treasury, and who are less likely to be left unpaid by their clients, you have a different set of incentives. So you're not under as much pressure as an SME who, let's say, doesn't get paid by somebody and needs to find a way of moving money from Hong Kong to London or vice versa, and they will go to the trouble of opening up a wallet and using a stablecoin and things like that. So the incentives have been that have led to the growth have been for ease of cross-border payments and to get something as away from the inflation that was hurting you as an individual. But now, as more and more people see the efficiencies that are there, we'll see more corporates use it. We'll see other people provide the capabilities to abstract away the complexity of using this technology for their clients, and we'll see more of that grow. But we'll also see banks provide solutions that take away the complexity as well, like we've done. So I just think that the figures that we talk about, we need to kind of not assume that the corporate use of stablecoins is going to go at the same trajectory, but it's going to be a process. But at the end of the day, nobody ever woke up and said, I'd like to make a blockchain-based payable today, except us in here, right? But if we make things easier to do 24/7 for folks, they'll do it and it'll grow. Anyway.
Definitely a space to watch. It's a great note to end on. Unfortunately, we're out of time, but thank you all so much, and thank you all for joining us.